far we have been discussing about the basics of risk management, starting with the risk management framework. Then we move to slowly progressing towards the major risk for which capital maintenance is required. So credit risk we discussed preliminary basics about the credit risk, market risk, operational risk, and some basics on liquidity risk also we have covered. And also the regulatory frameworks also we have discussed something about the Basel guidelines. So applicable norms, regulatory requirements, statutory guidelines, mandatory guidelines, stipulations put forth by the Basel Accord. Those also we have discussed. Now, in today's discussions, we will be concentrating more on the credit risk, which is the major risk which is coming under the risk management syllabus. So we have covered the basics on risk management, means credit risk management means what are all the credit risk portfolio, in which book of account it is recorded, that is the banking book of accounts. The accounting system is standardized accounting system, the accrual accounting system. The approach of risk management, risk measurement is standardized approach, and IRB, internal rating based advanced approach. Those things we have discussed. Now we will discuss more on the concentrating mainly on the risk weight assignment on various portfolio, various sectors and segments, how it is assigned, and also the loss probability calculations, how it is assigned and the probability calculations, and also something on the variance of credit risk. Some major risk while we were discussing risk identification. You remember that risk identification, one case study we have discussed, 1 crore deposit for 3 years we have sourced. Then it was invested in a 5-year loan investment, and we have actually identified so many risks from that, including default risk, credit risk, default risk, time risk, funding risk, gap risk, then reinvestment risk, embedded option risk, all those kind of risk we have discussed about the identification parts. Then we move to measurement parts. We know how to calculate regulatory capital using the formula exposure into risk weight into CAR. CAR calculation also we discussed. And as per the Basel guidelines, it is 9% for all in banks in India. So those kind of things we have discussed. Now we will move a little bit further, advanced portions in the risk management, credit risk management. Then we will move to operations, market risk, liquidity risk, etc. Something advanced. Let us see one by one. So, credit risk management, what are the learning objectives in this advanced session? Understanding the concept of credit risk, we have already discussed, covered in the earlier sessions. Types of credit risk and credit risk mitigation techniques. So, the basics we have discussed, we will move more, we will progress towards the advanced steps coming under these concepts and risk mitigation techniques, etc. Understanding the concept of capital requirement. As you know, the Basel I Accord, 1988 Basel I Accord, it was stipulated that minimum capital requirement is the basis, which is the basic requirement, which is the primary, which is the most important requirement of credit risk management process, which is the minimum capital required. That's understanding the concept of capital and its requirement in banking. We will discuss more on this capital requirement and its requirement here. Credit risk measurement approach, we have discussed credit risk measurement approach in detail, because that is the most important part. Every sessions I used to quote that this is the mark scoring topic, the measurement, which will give you the more and more marks. Unless you attend this numericals and case studies, you are not going to come out successful in this examination. So this is considered as the most important topic in our risk management classes. So measurement approach, standardized approach. We calculated standardized approach, the measurement of capital, that is the regulatory capital calculation, and risk weight asset calculation, how it is calculated, risk weighted asset. As we discussed in the credit risk management session, some 3 sessions back, you remember. Risk weight assessment is, risk weight asset is nothing but the exposure into risk weight. Risk weight is assigned by RWA. It will be advised by RWA for sectors, segments, etc. So, risk weight asset calculation using the formula capital is equal to exposure into risk weight or risk weighted asset into CAR. So, RWA calculation is capital divided by CAR will give you the RWA calculation. We will do some numericals, we will discuss some case studies also under this topic. Then we will move to the capital conservation through RWA optimization. So, risk weighted asset optimization, you have to conservation of capital, how it is conserved. If you are keeping more capital also, it is not good because you are required to keep a capital of 11.5 percentage, 9 percentage plus CCB. Capital conservation buffer of 2.5 percentage, which is mandatory as per the Basel III requirement. So now it is 11.5 means, okay, you can keep more and more depending upon your loss portfolio, expected loss portfolio, that is the risk profile. According to your risk profile, you can keep. But keeping more than what is required is not also, it is advisable. Why? Because it is an idle fund. That fund is not available for lending towards the profit generation. So that is also, so conservation of capital has a very important role. In your master data, if you are assigning, if you are entering data wrongly, for suppose, for an example, the risk weight asset, this is only an example, we will come to that point when we discuss that chapter. Risk weight asset for this credit card exposure is 150 percentage. For staff loan, it is 20 percentage, risk weight asset, what you call the RWA. So, the risk weight, the risk weighted asset, the risk weight for that particular asset, if it is staff loan, it is 20 percentage. If it is a credit card exposure, it is 150 percentage. Imagine if you are wrongly entering that exposure of staff loan as credit card exposure, how much you are supposed to keep a capital? Your risk weighted asset will be 150 percentage of your exposure. So, when you wrongly enter in the master data, your sector or segment or product or whatever it is, depending upon which the risk weight is assigned by, allocated by RBI, if it is wrongly entered in the system will calculate capital accordingly. So, instead of keeping a capital of 10 lakhs rupees, 150 percentage, 150 lakhs you are supposed to keep at that point of time. So, that is why the need of capital conservation through RWA optimization discussion here. So, you need to be very, very careful while allocating capital. You have to enter very, very correctly, thoroughly understanding the concept and all those things. Otherwise, you will be in trouble. So, that is the importance of capital conservation through RWA optimization. Here we discuss those things. So, there are 4 chapters mainly under this credit risk. We will be discussing one by one. So, concept of risk in banking, we have already discussed this one, but as a recap only, just you see deposits and loans. In the first session, but I owe you something. Whenever I owe you something, it is obligatory, it is mandatory, it is actually, it is my duty to see that my funds I borrowed from the public is invested safely, invested cleverly, wisely, so that I will get back the money on time and I can meet the contractual obligation. I can pay to the depositor on time. That is, the safety of fund has to be ensured. That is what it is stated here. The deposit, here the servers and bankers. The servers are the public. The public comes with the deposit and their hard-earned money is deposited in your bank. The bank, what we do, using that bank, the bank approaches the borrowers or the borrowers comes to the bank, we will lend money to the borrowers. So, that is why here it is our liability part, here it is our asset part. This is the source of funds from savers. So, bank is the mediator, they collect the money and they lend the money. That is the function of bank is described in this chart. The savers are liability. So, in the bank's balance sheet, this is our source of funds, source. So, this is our liability. The balance sheet, this is our liability side. When it comes to, so we use, this is the source of fund. So, source of funds, we use it here. We use it here. Also, we application of fund, we apply. The application, use of funds. This is our asset. This is our asset. So in this process, this asset, we are investing these funds. The bank is collecting money, investing these funds. This fund has to be collected back. So we have to get back the interest payments. We have to get back the repayment of loans. That has to be ensured. So in the risk management process, this is the whole process which are coming into picture in action. So you need to get back the interest payment, you need to get back the repayment payments. Here, what we have to ensure, that there is no default. If at all the default is there, we need to arrest, address, minimize, manage, mitigate, like that. So you need to see, this is the factor. Here comes the risk management. Here comes the risk management. Since it is deposits and loans, we are talking about the credit risk management. Simple. Credit risk management. Here, the default is the factor we need to consider. Default. If it happens, how much will be the loss? How much will be the probability? If it happens at that time, what is the exposure at default? If it happens, how much loss we are going to incur? That is what the three terms which we discussed in our earlier sessions: probability of default, exposure at default, and loss given default. Here we need to consider all those things into your area of concentration is these three things. The default has to be addressed. So because we are investing the savers' funds into the borrowers and making money through interest and repayment. If it is delayed, if it is defaulted, we will be in trouble. Where we will be in trouble? We have to pay interest payments. This is our duty. This is our responsibility. This is our contractual obligation. We have to do interest payments. We need to see the withdrawals. When the party comes for withdrawals, we have to pay money. For that, we have to collect money from here because we have invested here. It has to come back. This is a cycle. So this is the sum and substance of the credit risk management. Here, all these transactions, at the transaction level, these things are happening. So withdrawals, if you are not able to meet the withdrawal obligations when the party comes for withdrawal, if you are not able to pay, there comes the liquidity risk. That is also has to be addressed. Interest payments, we need to pay interest. There also, we should have enough liquidity. That is why liquidity coverage ratio we were talking about in our earlier sessions. So interest payment also needs to be met, and also withdrawals also we need to maintain. We need to keep adequate fund with us. That funds we are getting from the borrowers while they make the repayment loans or interest payments. So we need to ensure that the money is flowing in correctly, on time, without any gap. So those kind of risk has to be managed. This is the process of risk management when we discuss the credit risk management. Any deviation or wrong negative side from the expected outcome is termed as risk. We know that the risk. What is the risk? Any deviation, because you are targeting 100 lakhs profit this year, you are not able to achieve that profit, you ended up at 80 lakhs, that's a risk. 20 lakhs less than whatever you have projected. So your projections, you made the projections accordingly, you have made all the investment decision, all the investment plans, everything. So everything will be distracted. So that's a risk. That is what it is stated here. Any deviation on wrong negative side from the expected outcome. Suppose 100 lakhs is your profit. 100 is your profit. It has come down to 80. So 20 lakhs minus. 20 minus is a risk. This minus is a risk because you have not achieved whatever you have projected. There is a risk. All your projections have went wrong. In other words, risk implies future uncertainty about deviation from accepted outcome. So in the next year, we have projected 100 lakhs. If it happens, if this negative 20 happens, there is an uncertainty. It may happen. If it happens, what will be? There comes the importance of maintaining capital. That is the capital requirement, because this capital will take care of what? This uncertainty. If at all this uncertainty of minus 20 happens, this 20 will be taken care of by our capital. This will be absorbed. So we have adequate capital. There is no need to worry about, because we have actually adequate capital has been maintained, kept. Every year we will be plowing back a certain portion of the profit from your P&L account, and you are putting it as reserve in your capital account. So that amount will be acting as a buffer fund. It will be a cushion. So it will take care of the losses. That uncertainty is taken care of. So if such uncertainty is there, that uncertainty is a risk. That is what is stated. It is something more. Discussions comes. We are progressing towards something more step by step, towards discussing more on the credit risk. So risk implies future uncertainty about deviation from expected outcome. If expected outcome is 100, 80 is the actual, this is the deviation. So if there is a deviation, that is a risk. So all these are coming under the definition risk. Simple. So it is an expression of danger, or of course run into danger, the risk here. It is an expression of danger or probability of suffering loss. That is the risk. Banking is basically about doing business of intermediation. This is intermediation between depositor and, see what he is doing here. This bank is intermediary, acting as an intermediator. See, they are acting between saver and banker. That is why it is stated here, banking is basically about doing business of intermediation between depositor and borrower. Liability, assets. Source of funds, use of funds. Application of funds. There we make profit. This is our, when this profit, these assets, when these assets mature, this is our cash inflow. Cash inflow. You understand the concept? This is the cash inflow. When this asset matures, that maturing asset will pay you as interest and installment, as interest and repayments. It will come to your cash cabin. It will come to your cash bin as inflow. This is the inflow. So this inflow we need to pay out to what? Interest payments to depositors. When they come for withdrawals, we will pay the maturity deposits. That is our cash outflow. Cash outflow. So cash outflow is what? Maturing liability. So maturing assets and maturing liability. So understand the concept here. Whenever this, while we do the intermediation, whenever the assets, the borrower's loans and advances, that is the assets, whenever these assets matures, it is coming back to you as interest payment and repayment of loan. That is your cash inflow, because it is coming to the bank in your cash bin. So that is your inflow. That inflow, that cash, we use it to pay out to the depositors. That is outflow, cash outflow. So outflow and inflow concept you understand. This is maturing asset is our inflow, maturing liability is our outflow when it matures. That we will discuss. So through this process of intermediation, bankers are trading the risk. Of course, buy and sell. You know what is the transaction taking place in this day-to-day, in the market? There are two types of investment, daily or long-term investment or intraday investments. So what is happening there? Buying and selling is happening in the market. So now we are discussing credit risk. Here what is happening? Of course, buying and selling only, but the products are different. There the products have a mark-to-market accounting system in the market. Here in the banking book of accounts, when we discuss credit risk, there is an accrual accounting system where the securities included accounted in the banking book of account is called a HTM security, held to maturity securities. What are held to maturity? It is held for a defined definite maturity period. There is a fixed maturity period is there for each security. That is HTM security. The savers give us HTM security and we lend it towards the borrowers as HTM securities. These HTM securities we are of course trading, like trading in the market. We are sourcing from the public, we are selling it out to the borrowers. That is why we use the word trading the risk, which is basically earmarked to depositors. We are trading the risk actually. When we trade this product, we are trading the risk. Trading the risk means we are consuming, we are taking, absorbing some losses, some risk also. That is why the risk management comes into picture. So that is the implication. Through this process of intermediation, bankers are trading the risk, which is basically earmarked to depositors. Because the depositors, it is actually our duty. It is our duty to see that because the bank owes some deposit, some amount to the IOU clause. We owe something to the savers. So it is the duty earmarked to the depositors, this risk. So this risk has to be addressed because we need to meet the contractual obligations of paying back to the depositor. So we need to address the risk. That's why the credit risk measurement, the credit risk management process has this much importance. You see, what is credit risk management? We have discussed some basics about credit risk management. So there are so many parties involved. There are so many systems and procedures involved. There are so many departments, officers, hierarchy, all those things, framework. We have discussed about the framework. Just something more on that. What is credit risk management? How it is managed? So the credit risk. So whenever the deposits and advances are there, there comes the credit risk. Deposit and advances. Loans and advances. Deposits plus investments. Sorry, borrowings. Here the borrowings is your source of funds. Borrowings from the market as well as deposits from the public. Loans and advances plus investments also we do here. But when the credit risk comes, we are concentrating on deposits and loans and advances. So when we discuss market risk, we will discuss the borrowings and investment. So here what we will do? Now we are going to discuss this one only. Credit risk, deposits. Here comes the user application side, loans and advances. Banking book of accounts, credit risk. So what is the credit risk management? It has to be managed. So the credit risk management evaluation comes from where? First you need to evaluate the lenders. Here the lenders, because you are using this public deposit, you are investing to these lenders. You are giving money to these lenders. Though evaluation is the first process. That is the what you call your credit appraisal and analysis part you are doing first. The 5 C's which we are mentioning earlier. Character, capital, capacity, collateral and conditions, market conditions, etc. All those things we do. We evaluate the proposal, the lenders, everything, the past historical financials, ABCD, all those things we evaluate. Then we are ready to take some risk. So when we take the address to take some risk, so these lenders, from lenders, see here the borrowers. So the lenders involves what? The lenders are your source of funds. Your money, even the depositors are your, as far as bank is concerned, they are lending money to the bank. The depositor is depositing money means they are lending money to the bank and you are giving back them interest, paying out interest to the lenders. So in that process, that money we use it to the, here comes the borrowers, assets. Okay, so the deposits we collect it. So we are prepared to take a certain quantity of risk we have measured, the admissible risk, we are ready to absorb that risk, then we are lending money to the borrowers. The borrowers, when we lend it, to identify the chances of default. So this is the first and primary thing we need to address in credit risk management, to identify chances of default before approving the loan. Before approving, that is why the credit appraisal and credit analysis. So appraisal is about the borrower, the market, and the macroeconomic scenario. Analysis is the financial, audited financial, all the financial statement, the ABS, audited balance sheet, then the P&L account, the cash flows, all those things you analyze. So analysis, financials, and the microeconomic condition, market condition. Microeconomic and other market condition. That is the productions, demand, supply, all those things you appraise. So appraise and analysis, these two things you have to do first. So there, before approving the loan, you do all these exercise and you arrive at a conclusion that this exposure we can take into our books. But these are all the risk. There are some risk are there. These are all the ways to address that risk. These are all the ways to control and monitor that risk. These are all the ways to mitigate the risk. So those decisions you have arrived at, then you came to the conclusion that this is okay, we can take the risk. Then you go to be prepared to tackle the unexpected events of default. Unexpected events of default. This is called what? Expected loss calculation. So the uncertainty has to be addressed. That is also the credit risk management. The process involves be prepared to tackle the unexpected events of default. Something if it happens. That is why every year we say that a certain percentage has to be plowed back to strengthen your capital base to take care of this one. Unexpected events to take care of. Such measures, you have to bring in additional capital. You have to strengthen your net worth, your capital base more and more stronger and stronger. The ROCE benchmark, hurdle rate we were discussing earlier. The hurdle rate should be the benchmark to see how much financial strengthness is there for that particular institution. So those preparedness, we have to be prepared. We have to evolve some strategies to make our capital base strong, which will take care of any unexpected events of default. So ultimately, our capital base should be strong. That is the only way to take care of the unexpected events which may happen. Otherwise, over a period of time, the capital will be eroded and it will end up in bankruptcy. So then again, it comes like that. Then the lenders, again, this goes like that, this comes like that. This is the process involved in this credit risk management process. Then comes credit risk is the possibility of losses due to credit rating downgrade. Rating downgrade is also one of the possibility to increase your risk. Credit risk will be increased. Whenever the asset quality is getting deteriorated, any reduction in the quality happens, there is more risk is there. Suppose for example, AAA rated company, the best rated corporate exposure, it has been downgraded to BBB. Your risk weight asset, your risk weight for that particular exposure will be more. If it is 75% for AAA, for BBB it may be 125%. So your risk weight will be more. Your risk percentage will go up. Your risk taking capacity, that means you need to find more capital from the market. So that is what it is stated here. Credit risk is the possibility of losses due to credit rating downgrade also. Downgrade also will lead to credit risk. Inability or unwillingness of a customer or counterparty to meet commitments. Inability to meet commitments means it is default. So it is what it is signed in the loan agreement when you exchange a sanction letter. So I am obliged to. So I undertake to repay my debt on such and such date. So they sign like that. If they are unable to meet that commitment, both principal and interest in relation to lending, we are talking in relation to lending, trading, settlement and other financial transactions, there comes the risk. So the risk happens due to unwillingness of a customer or counterparty. The counterparty, if also fails to meet their contractual obligation, there will be, of course, there will be a risk. So, it will lead to a losses, possibility of losses. So, in relation to lending, trading, settlement and other financial transaction. Alternatively, credit risk losses result from reduction in portfolio value arising from actual or perceived deterioration in credit quality. Deterioration in credit quality means, what is the best example for deterioration in credit quality? Standard asset, slippage of standard asset to SMA or NPA accounts. That is the best example. This is getting deteriorated. For standard asset, this much provision is there. For substandard asset, more than that. For doubtful asset, more than that. So, provisioning requirement will also be more. This provisioning requirement will become more. What will happen? So, it will eat away a portion of profit. It will reduce your profit. Sometimes it may end up in loss also. So, that is the danger involved in such kind of transaction if it is not addressed properly. So, goal of credit risk management is to maximize bank's risk adjusted rate of return. That is what is this risk adjusted rate of return. This is what we have been discussing repeatedly. So, goal of credit risk management. What is the goal? Is to maximize what? Bank's risk adjusted rate of return. Maximize return. What is the goal of any bank is maximize. Maximize was return. What type of return? Risk adjusted return. So, you have a P&L account. P&L account. Your net profit. Suppose it is 100 lakhs. Your risk, cost of risk. So, what we term this cost of risk as expected loss. This is the cost of risk. This is the cost of risk. Expected loss, we reduce it, suppose it is 20. Now 80. 80 is the risk adjusted return. This risk adjusted return, after reducing, after factoring the risk component from your net profit, you have recorded a profit of a return of 80 lakhs, which is the risk adjusted return. If it is more, what is the meaning? What is its implication? If the risk adjusted return is more, it is well and good. So, that is the goal. That should be the goal. Goal of credit risk management is to maximize bank's risk adjusted rate of return by maintaining credit risk exposure within acceptable parameter. Within acceptable parameter. Of course, we cannot jump out from the framework. You are supposed to play within a frame which is designed and given by your regulator. You have to play within that. You cannot jump out. So, that is what it is said to say, by maintaining credit risk exposure within the acceptable parameters. So, we have to ensure that the acceptable parameters are achieved. What are the acceptable parameters? We will discuss one by one. So, now you understand the concept of credit risk, the process of credit risk management, what are all the parties involved, how it is managed, what exactly is the credit risk. That is what we have been discussing.